Hi everybody, Morgan, the Mortgage Guide here, and many of you have seen the news. The Bank of Canada has increased the overnight lending rate by another 0.5, so I felt it appropriate and important to just make a little bit of a video because there's going to be, again, a lot of noise about this. There's going to be a lot of stress that's being caused by this, and I just want to sort of paint the whole picture so we don't get caught up in this whirlwind of headlines. I wanted to take the opportunity also to talk about two things that people tend to forget to focus on when we're talking about fixed rates, variable rates, overnight lending rate, etc. So I wanted to give a few important facts, and then I wanted to talk about capital repayment as well as prepayment penalties, two very important factors to look at when you're deciding whether to go fixed or variable. But first, just to put things into perspective, in February 2020, the prime rate in Canada was 3.95. In March 2020, 1 month later, we went from 3.95 to 2.45. That was the largest drop in Canadian history, and it was, of course, because of the pandemic. Now, with the economy gearing back up, inflation higher than where the government would like it to be, people back at work, back spending their money, we are now moving back towards what would have been the normal rate of prime had there never been a pandemic. Is it a bad thing? Not at all. Are those who got their mortgages during this historic low feeling the pain? Probably more than they were expecting to, but that is because they bought so low. But remember, as of today, the prime rate is 3.7, which is still lower than what you would have been had you bought in February 2020, right before the pandemic. So we're only on a trajectory now, which has taken half of this year, not 1 month, but half of this year, to kind of get back to where we would have been had there been no pandemic. So, is this a reason to panic? No. And there are two things, like I mentioned, that I want to talk about. So the first one, which I've explained to many of my clients, but I felt important to take the time to just explain to everybody. Capital repayment. When we get a mortgage, every month we make a payment. Part of that payment is interest, and part of that payment is capital, principal, what you have actually in debt that needs to be paid back. If you start with a variable rate mortgage, you are starting with a lower rate, significantly lower rate than had you taken a fixed rate mortgage. And what that means in practice is that every month, that monthly payment is less interest and more capital than if you had a fixed rate. With a higher interest rate, you would have had more interest and less capital, comparing the two side by side. And what that means is that every month your debt is going down a little bit faster. Now, if you're thinking about how you have 15, 20, 25 years to pay off that entire debt, you mustn't forget that by paying down more of the principal, that means that the amount of interest you have to pay on that debt is less because you owe less, which means that even as rates go up, you are paying down more, which over the whole of your mortgage is going to save you more money. So sometimes it's hard to focus on that, but at the end of the day, you're not only looking at how much interest am I paying today, but how much interest am I going to pay over 25 years? And when you look at that, how much interest I'm going to pay over 25 years, well, we're not talking a few $100s difference. We're talking tens of thousands of dollars of savings by paying down your capital more aggressively. The second thing, which is very important to not forget about, is the penalties. So right now, the average penalty if you break your mortgage from selling your property or refinancing your property, it is 9 times higher on a fixed rate than on a variable rate. And so think about that. That means that if you sell your property, and nobody sells or refinances in exactly 60 months, because life doesn't work in exact 5-year increments. You most likely will sell before or after. So if you had a $1,000 penalty on a variable rate, that means that the average fixed rate penalty would be $9,000. So just think about that. The chances of you losing money taking a variable to a fixed historically have been basically nil. But even if that were to happen and your fixed rate would have saved you $2,000, $3,000, $5,000, you'd still have to save upwards of $9,000 or $8,000, I should say, in interest to only break even on your fixed rate compared to your variable rate. Because even if during that 5 years you saved a little bit in interest, you're losing it when you break that mortgage. So 2 very important facts. You're paying down your mortgage faster on a variable rate, which means that overall you're going to spend less money on interest even as rates rise. And second, when you sell or refinance that property, you're going to be also saving on the penalty. Those are 2 big factors. A 0.5% increase today, bringing us to below where we would have been pre-pandemic, is not a reason to panic. So I want everyone to take a deep breath and remember, if you think and focus on the facts and you don't get caught up in the fear, you will probably make better decisions. So if anyone has any questions, all my contact information is going to be above. Thank you very much for watching and have a great day.